Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you're with us today. Both myself and my co-hosts, we are both financial advisors, certified financial planner, chartered financial consultant. We spend our weekdays with helping people like yourself plan their financial futures. And we broadcast our show here on the weekends to be your financial advisors on the air. Whether you're listening to us old school terrestrial radio or podcast, we're glad you are participating in our program today.
And we've been doing this show for 25
years.
Yeah, and the whole goal from the very beginning was to help people find financial peace in their lives, whatever that is. And it's not always the most money. It's living comfortably with the money you have.
Well, it's not the most money because if that's your goal, there's never enough.
Well, yes, I don't know. I'm not at that level where
correct. That's my whole point. There's never quite enough.
Yes.
Right. But so if we can set aside that we all have finite resources, our hope and our goal is that people make good choices with their finances so that they have some financial independence in their life. So work is a choice and not an obligation. So they've got the flexibility in their retirement years to do things that's important to them, to be able to see the grandkids and have some dignity in their life and be able to pay for their health care as they get older. And that's really about, and it's not that, for most people, it's not about accumulating as many dollars as quickly as possible so you don't ever have to work again or serve others again. Most people, it's just being at the point where they have some little more control over their lives, have some more flexibility in their lives.
And financial security. And we talk about retirement, but retirement isn't for everybody. But you should plan as if you're going to leave the workforce.
Well,
at some point in time.
48% of people retire earlier than planned. This weekend, I ran into this past weekend, I ran into a buddy of mine that I'd known Tom for about almost 30 years. I hadn't seen him in a long time. I used to run with him. He played football for Stanford way back in the day, and he still looks fantastic, massive shoulders. Anyway, I ran into him, and he said, "Yeah, I got my job is being eliminated." And he says, "I'm about 3 years shy of where I want to be."
I had the same conversation.
3 years shy. He says, "I was planning on 3 more years and all my finances would have lined up, but now I got to figure out what to do." He says, "I don't think I'm quite there where I can be retired. It's not going to be the kind of retirement I want. I needed 3 more years, and now I'm kind of stuck."
I had almost an identical conversation with a friend of mine and his wife this week. Job was being eliminated, 58 years of age.
That's even a worse age.
We think we have enough to retire. But we really don't want to dig into the nest egg quite yet. So I'm just trying to find a job where I can, quote, skate by for a few years. Like, that makes sense. You don't really need to, they're at a point where they said, we don't really need to add to it. We've got that. We have no debt. We think we're almost there, but we're not really quite ready to leave the workforce yet. And we think that we need a couple more years for...
Well, most people really don't know. They have a guess, but unless they work with a good financial advisor or are very astute when it comes to financial markets, have a realistic rate of return expectations, realistic inflation expectations, all those other things, they just guess. They have no idea.
Well, actually,
what we've noticed, over the years of doing that, when they go through a financial planning process with somebody, they typically feel more confident about their future, et cetera.
Well, as they said, we know we have enough that we could do it today. But it isn't quite where we're 100% comfortable. And by the way, we don't really want to leave the workforce. The same couple. They were both. They were visiting me from out of state because the wife had quit her job and the husband was laid off.
Lost his job.
And they're like, the kids are all gone. So we took 6 weeks and drove around the Western United States visiting friends. I'm like, good for you.
Good for them.
Good for you.
Oftentimes, it is an emotional struggle for someone to lose their job prior to retirement. Particularly, they've been there a long time. They need another 3-4 years to get their financial house really where they want it to be. Yes. And then suddenly they find themselves there. And here your friend was what, late 50s?
Yeah, 58.
58. Like, here's a lot of people are still working are still wanted and needed in the marketplace, and it feels like you're no longer wanted nor needed.
Well, it's interesting. It's interesting. You have these conversations with your clients. We have them with our clients all the time, which is, look, I'm 58, I'm 59, I'm 60. I don't want to leave the workforce, but if I'm going to go back to a job, I'm not going to go back to the same job I was when I was 28 and grinding it out on a plane every week.
Or whatever that job was.
Right? Yeah. Right. I'm not looking to move up the corporate ladder. I'm just looking for a place to hang out for a few years and add some value.
So, I mean, look, we really do believe it's important that people are prepared for retirement, whether they plan on never retiring, just being in that position. 48% of Americans retire earlier than planned. The Voya Financial Studies, there's been a bunch of studies that show roughly 1 in 2 of us retire earlier than planned, either because of a job change or a health issue with themselves, a health issue with a family member or whatnot. But anyway, we got a great program lined up today. And if you want to be part of our program here at Allworth's Money Matters, you can join myself and my co-host, Pat. Our contact number is 833-99-WORTH. That's 833-99-WORTH. And we'll take some calls here in a moment. But the two issues I want to talk about. One is the relief bill, so-called relief bill. $1.9 trillion. So
what are we at now? We at 5-6 trillion since the beginning of this?
I don't know. When you add this on, we're somewhere in there. And the U.S. government had, we as citizens, we're already over $20 trillion. And now we're over 100% of our gross domestic product.
Which is a little scary because you need to measure the amount of debt against some sort of benchmark.
If you were a family and had $150,000 a year in income and had $150,000 in consumer debt, you'd think, wow, that's a little high.
Yes.
That's kind of another way to look at it, right?
Perfect.
But I almost find myself I saddened by it, I got to tell you, because I look at all this additional money that we're throwing, and less than 10% of that was close to the vaccine stuff. And I'm 100% supportive of helping those, particularly those that the government came in and shut down their businesses, and the response to the pandemic caused great pain. I'm 100% supportive of us providing help and relief to those people. What is frustrating, I think, is just all the various things that was thrown into this that has nothing to do.
Scott, a rescue package for pensions? It had nothing to do. Nothing to do with the pandemic. This was years and years and years and years in the making. So I'm part of this package.
It was. You're right. And there's other bills. Years. It was to bail out multiple employer pension plans, which are primarily union pension plans.
$86 billion to 185 union pension plans.
$86 billion.
To 185 union pension plans. What does this have to do with the pandemic? This issue, it existed long before the pandemic. This, by the way, won't fix it. All it does is delay hard decision-making, painful decision-making.
This was a huge bill. It wasn't, where'd the $2,000 number come from? I think that was something that just Trump threw out there. Why was $2,000 the number that families needed? They got $600 before, so they're getting an extra $1,400 on this one. Why not $2,100 or $1,900? And why isn't it phased to those who actually need it? It's based upon income level, so if your income's too high, you're not going to get it. But there's some people, maybe they need more than that, and others that don't need it at all.
Yes.
Some people... I know a lot of people whose incomes were up last year.
Yes, but
some businesses did great,
but not above the threshold.
Anyway, I think, and I don't want to sit and get the nitty gritty of it because everyone has a different viewpoint on this. But the thing that is that concerns me long term,
debt.
How do we eventually pay off this debt?
It's debt. It's debt. It's just like
the borrower is slave to the lender.
It looks just like a window is opened and everyone is just trying to push pork through. That's what it is. Under the guise of pandemic. And by the way,
a fully partisan bill too.
Most of the stimulus package that was in earlier bills hasn't been spent and isn't actually...
Over $1 trillion hasn't even been spent yet.
And it's not even scheduled to be spent for the year 2022, year 2023.
So you wonder how much, if this is going to put, and the economy is already looking really strong.
Yeah, inflationary.
Well, that's the biggest concern I have. What's this going to do in inflationary pressures? Even if it's not the debt, the issue, just you throw that much additional money, supply versus demand. Suddenly, what happens when the economy opens back up and there's 10% of the restaurants?
Scott, we're already seeing it. There's inflation in bicycles, boats, and RVs right now. It's true.
Oh, 100%. And good luck finding those things. Supply and demand.
Yeah, why? Well, because as you pointed out earlier, not everyone was injured because of the pandemic,
That's right.
but they're getting extra checks. They're getting extra checks.
Yeah, talk to someone who owns a bike store. Ask how their year was last year or now.
Or boat or RV.
They're having trouble getting supply. Anyway, I find it all... So, I mean, as an investment advisor, as one... We're co-CEOs of an organization that has 13,000 plus clients, over $10 billion of money, primarily retirement dollars that we have a responsibility to shepherd. One of my longer term concerns is inflation. That's one of my top concerns.
Yes.
And it's keeping an eye on those things, like when inflation's going to start.
What's it going to do to the economy?
And portfolios, and how do we have things structured for that as well. So anyway, if you want to be part of the program, 833-99-WORTH is the number.
And we'll take your call.
We're starting with Jeff. Jeff, you're with Allworth's Money Matters.
Hey, Pat. Hey, Scott. I have a question regarding where I'm going to put some dollars that are coming due in a CD the end of the year. Well, let me outline it from the beginning. This is part of an inheritance that my sisters and I got from our parents when my mother was the last one to pass away, and she passed in 2017. There was a brokerage account that had a value of about $120,000, which has been split three ways between myself and my two sisters. One of my sisters is special needs, and her portion's in a family needs trust. And then there were cash assets of approximately $150,000 for each of us that we have. We put a lot of that cash into CDs in 2018. It happened that our credit union made a what I consider to be a really fantastic offer. They had a three-year graduated CD that made 2.5% the first year, 3% the second year, and 4%
You're getting 4% on CD money right now?
Right, in this year.
Wow.
Year.
Good for you.
Yeah. It was something that our credit union offered, but of course they will not be offering that after the end of the year. But I'm considering adding some of my portion into the brokerage account that I had and building it up. I'm just not sure. I'm almost 70. I'll be 70 later this year. I'm really not living off of this money. It's been sitting there since my mom and dad had it, and I haven't been doing anything with it. So I'm thinking,
what would you like these dollars to go towards? So this came from your parents, right? You've got it today,
right?
You haven't spent any of it, and it's been 4 years. What would you like these dollars to do for you, for family, for whatever?
Probably just go in for some sort of growth and be there for my daughters when I pass.
And do you have ample assets to take care of your own needs? This you won't.
Yes, I do. I have two accounts, or two IRAs, I should say, and the total between the two is $1.2 million.
Okay. It's interesting. Sometimes my father passed away a little over a year ago, and I received a relatively small inheritance, and it's kind of I feel funny about blending it with the rest of my money. I kept the separate account, and I'm a financial advisor.
Really?
Yes.
That's unusual.
I know, but
that surprises me.
And I've decided I'm gonna use the dollars for my nieces and nephews when needs arise.
Oh, that's nice.
What you said, Scott, I
For me-
feel basically the same way. I just kind of want to leave it in an account. That was my folks' money, and leave it for my kids.
Well, then,
So-
that's the most important thing, which is what are the objectives of the dollars?
Yeah, anytime we look at an investment opportunity, one, what's the goal? Like, what are the objectives, as Pat said? In your case, Jeff, you say, well, ideally, I'd like to leave this for my daughters. So, and then the second thing we look at is time horizon. How long do we have before we need these dollars?
And would you be giving any of these dollars to your children in the next 5, 10, 15 years, do you suppose?
I don't think so. At this point, I think they're fine for now.
Okay, so then we've got a timeline of 15 years for these dollars, right?
And that's assuming that your
Yeah.
kids would spend it the first day.
And under current tax law,
Who knows there?
Who knows? I know.
right? And then,
My oldest daughter would be gone before the week was out. But anyway.
but under current tax law, what's the best ways to actually do that, right? And I would say that you're better off actually putting them in a brokerage account with some highly tax efficient.
We're keeping this as separate brokerage account.
That's right.
Having these dollars earmarked.
So that so there's no ambiguity about what the objectives are. So it's not commingled with any other dollars.
And you've got the luxury here, Jeff, of being able to invest in something and not worry about what the value is on a daily basis.
Only what it's going to be in 10, 15, 20 years from now is all you're focused on.
Right.
Right? So I think about it the same way I thought about putting money into a 529 for my children when they were born, which is I don't really care what it does year to year. I just care what it's going to be the value at their age 18. So it's got 18 years to grow, and it would be invested towards that end. So I would make the argument that you should have a highly, highly aggressive portfolio in terms of equities.
Yeah, I think what Pat means by aggressive is not like trying to pick some hot stock. But let's just say even if you owned, let's say, the S&P 500 or the total stock market index, just the factors of production in this country.
Yeah.
Mm-hmm.
Your statistical chance of for a greater return is much higher there than even in the 4% CD.
Oh yeah, my thought is I because right now with the way the account is structured, it's pretty well, I would think, from what I'm seeing, about 65-35 split, and it's more towards bond funds. And so I'm thinking I would want to get more into stock.
Yes, 100% agree.
Yep.
You're thinking the right way, Jeff.
Yeah, and I might put this right now, just for a comfort level, is maybe 80% equities and 20% bonds and cash, and put it in a separate account.
It's going to fall.
Yeah, just realize.
It's going to have the next 5 years, there will be some period where it's going to be ugly.
But you don't care as long as you get to the 15, 20 years out, which is, right, you're 70. Right. Statistically, you're going to be you're going to live to be 86.
Right.
Right. So if you have a normal life expectancy,
is what I figured.
Yeah, if you have a normal life expectancy, so I'd invested that aggressively. And
I agree.
You know,
with that
and it wasn't a bad thing to put it in the bank CD 3 years ago because it gave you time to settle down and emotionally think about it, which is a really important part of investing, is actually how people respond to or react to their portfolios and how they're doing. It's probably the hardest part of investing, is actually taking the emotion out of it.
Yeah, the other thing, and I'm probably going to be not doing quite so aggressive on this one, but I'm the what do you want to call her, the trustee for the part of it that's part of the estate that's in trust for my sister.
Yeah, that's a very different situation. That she needs
Right,
income each year.
Well, she doesn't need a lot. She is she lives in a group home, and she gets through my parents and that she's on SSI, so that covers her actual living in the home. So she needs money for extras that she might need, etc. So she's spending maybe $2,000-3,000 a year on.
Yeah.
Okay, and how much is her money set aside? So for earlier, I was going to ask about that. Jeff mentioned earlier, just kind of as a side note, that he had a sister that was left money in a special needs trust. And we were going to get to that, asking you who is responsible for managing and what the income needs are there. So those are two separate decisions, right? So
Right.
one
Completely.
is money in 15 to 20 years, and the other one, it needs to generate some current income. How much money is in the special needs trust?
In the trust, it's about right now. I think it's around $175,000 between the cash and the brokerage account, because she's also got right now it's close to $50,000 in the brokerage account.
Got it.
And
So
then about 130, I guess it is, in cash assets, because she had a CD with the credit union also.
Yeah, I mean,
so that one I would put all in the brokerage account, and I would go a 50-50 portfolio on that and generate the income, but still allow for some growth.
and if you think about it, like how much cash will you possibly need over the next 5 years? That 5 years, those should be in conservative dollars. Anything beyond that, I mean, you have time to ride the market cycles. And they're going to go through cycles, right?
Right. My thought is I'm going to leave probably about 20 to 30,000 of it in cash
Perfect.
in the credit union account, either in a money market,
Whatever's
or
easiest for you to manage.
Perfect.
Yeah, and then the rest of it would be in the brokerage.
All right, and then the last point before we go is you have named someone to take over those responsibilities if you predecease your sister. Have you done that?
Yes, my other sister would take it over.
Okay,
and
perfect.
If she's gone, it would probably fall to my daughter.
Perfect. So just make sure that that's documented somewhere legally.
Right. It's in the trust. Yeah.
Perfect. Great job. Good job. So I like that idea for invest those dollars completely separately, one for the special needs and one for the growth for your own children.
Right.
All right, Jeff.
Okay. Appreciate it,
Yeah, I
guys.
wish you well.
Appreciate it.
You know, and rather than jump to the next call, you know what I appreciate about Jeff's call? There's three different investment needs there.
Yes.
We didn't talk about Jeff's personal one because he has money in an IRA. I don't know how that's invested, but so right there's three completely different investment objectives that Jeff needs to make. One is the dollars that he's going to need during his lifetime, which there we need to make sure we've got money that's set aside, not tied to the financial markets, so we don't have to worry about. So if next quarter we need some dollars, or this fall we need some dollars, or next year we need money, we don't have to worry about something being down in value. So
that's his own money.
His own money. But then we also need to think of what happens if it's 75 or 80, and what happens if we have inflation. We need to make sure we have some growth in his portfolio so that the income he's pulling out 5 and 10 years from now is greater than it is today, just to break even, essentially. Then when you look at these other dollars where it's a very long term.
And he decided that because he could mix it with the rest of it, but he decided what he wanted use of those dollars to be for his children. Long time horizon. And then for his sister, he manages a special needs trust, which is both immediate need and long-term need.
And some would argue that, you can do all this just in one account, which you probably could, but not the special need ones, obviously. But sometimes it's beneficial to have a couple different accounts that are used for different things, just so you can view them differently. Now, from an investment advisor standpoint, we could build a portfolio and monitor certain securities within a portfolio and know that these are for different purposes. But sometimes for individuals, or families, it's kind of easier to have different accounts and say, all right, I'm not going to worry about what this account's worth on a daily basis because this account's not going to be touched for 5, 10, 15 years. Like my 401k. I don't worry about my 401k in the slightest.
Scott,
54.
I had a client, plenty of money, wasn't going to spend it all in their lifetime. I put it all in one account, and he and his wife kept coming back and saying, we think this should be more aggressive. And I said, this is appropriate for your risk level. And they said, look, you said we're not going to spend this all in our lifetime. We want it to be more aggressive for the growth of our children. And I said, I apologize. It makes complete sense. I'm going to take your single account.
What did you apologize for?
I probably should have listened better.
They probably didn't have that much clarity in there.
Might
Maybe you apologize for not helping them get that clarity earlier on.
That
because a big part of our job is helping people figure these
I
things out.
took the account that we had one account, and I split it into two accounts. And I said, this one account is invested for your children, and it will be very, very aggressive. We are not allowed to change our aggressiveness regardless of the market cycles.
You can't complain when it's down 40%.
Yes, and you can't brag about it when it's up, because the objective is 15 to 20 years out, and then the other account that you're going to live off of, that's going to be segregated. And the psychology behind it was brilliant. Not just because it allowed them to view it differently. So they had no reaction to the account volatility for the one.
Well, psychology is a big factor in making it. Most investors are not successful investors because their emotions get in the way. We're going to take a quick break. When we come back, we'll continue with some more calls. This is Allworth Financial's Money Matters with Scott Hanson and Pat McClain.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hanson.
Pat McClain.
And let's head right to the phones. And if you would like to ask us a question some point in time and be on our show, we'd love to answer your call. We enjoy, you'll find that we don't do a lot of like reading emails and stuff, because sometimes people will call up with one question and the question is maybe something different.
Completely
right?
different.
I mean, they think that the answer to their question is going to help them accomplish what their need or their goal is, but oftentimes it's not. So
that's because life doesn't live in a vacuum.
No. So to join our program, 833-99-WORTH, 833-99-WORTH, or numerically it's 833-999-6784. We're talking with Cecile. Cecile, you're with Allworth's Money Matters.
Hey, Scott and Pat. How are you two doing?
We're wonderful. How are you doing today?
Good. I'm well. Let's talk money.
All right.
So I'm a little earlier in my career, and if you ask my age, it's 32. And last week or the week before, I was talking with our workplace financial advisor, and we had talked about how my goals for earlier retirement. And so with the market drop last year, I started putting more money in a brokerage fund. And in our most recent talk, he said, I wouldn't do that. I would increase your contribution to your 401k, start drawing down the brokerage fund, and not contribute to that. Well, how does that make sense if, let's say, I want to retire at 50 and I can't draw from the 401k?
All right, so a couple things going on there. Yeah. First of all, there are ways to get to the 401k without being 59 and a half, without any penalty.
And just to, do you work for a state, municipality, nonprofit, or a private company?
I work for a nonprofit healthcare system.
Okay. So do you have a 401k or a 403b?
I contribute to the 401k.
Okay. All right. Thank you.
And do you have a Roth option at work?
We do. And when I joined, I had no idea of it, so I just went with the 401k because that's what I knew.
Yes.
And what's your approximate income?
About $90,000.
Are you married?
No.
You live in California?
No, I live in Arlington, Virginia.
Virginia. And do you plan on staying in? Well, who knows where you'll be long term? You're 32 years old. I don't know where I'll be long term.
So how much are you? So you were putting money both into your 401k and into your brokerage account. How much were you saving approximately in each one of those prior to this advisor giving you a suggestion?
Yeah, so I contribute 8% to my 401k. My company matches 5% of that. And then I max out a Roth IRA. And I was also putting $500 a month into a brokerage fund, and it's going into index funds.
So I would probably take that $500 and put it into the Roth 401k option. So you've got 8% of your pay going into the pre-tax 401k?
Yes.
And so you think of it like that extra $500 a month, just being able to throw it right into a Roth IRA, because that's kind of what it's like.
And what the benefit of that is what, Scott, versus a brokerage account?
Well, the brokerage account, you're going to end up paying capital gain tax, and you'll have some taxable dividends thrown along the way. If it's
on any growth.
In the Roth, it's called, all that gross can be tax-free.
And the liquidity is not quite as good as the brokerage account, but it's pretty close.
You can always get out your contributions before having to tap your earnings. Your contributions will come out tax-free, regardless of your age.
So you said to take that $500 from the brokerage that I was funding and put it into a Roth 401k.
Yes.
That's correct.
And buy the same index funds.
That's a great idea, guys.
I know.
Thank you. Had we been at your workplace advisor,
That's what we do all day long. Because I wouldn't want you to put more in the pre-tax because
it doesn't have the same liquidity
if you
as
were
the
making,
Roth.
if your income was double or something, then I'd say you're in a really high tax bracket. But you're not, probably not that high a tax bracket. You've got some going in pre-tax. You've got the Roth IRA. I love the concept of the Roth. Do you own a home yet?
I do.
Okay, yeah, even better.
And so, I assume you're concentrating on the debt in the home.
I mean, I'm making my monthly payments. I'm not making.
She's
extra
32.
rent.
I wouldn't. Just have a 30-year mortgage. It's fine.
Yeah, and I just refinanced it down, so it's saving me a little bit a month. And I might take that extra savings and probably pay it towards the principal. But
When you said you want to retire early, what is early to a
That's a good
32-year-old?
gosh, if you told me I could retire today, I would.
Really?
And then do what?
And do what?
It's not. I'd say let's call it financial freedom and not retirement.
Okay.
What I want to do, is find something else that I wouldn't have to worry about the money.
Okay.
Well, that's a very worthy goal.
And are you on a 30-year fixed rate mortgage or?
I am.
Yeah, pay extra to the principal. The sooner that gets paid off, the sooner you get to retire. Money not going out in retirement is exactly the same as money coming in.
Right. That's right.
Right.
So
Well, thank you,
the
guys.
less mortgage payment you've got, the less dollars you need saved.
So
Good
I
words.
like that idea. So take the excess payment, put it against the principal in the house, and then move the $500 from the brokerage into the Roth IRA or the Roth 401k.
All right. I'm going to look into this today. Thanks,
Good.
guys.
Do it today.
All right, appreciate
Don't put off till tomorrow. Call now.
Appreciate the call.
Yeah,
Thank you.
833-99-WORTH. We'll get you on Allworth's Money Matters. We're talking with Charles. Charles, you're with Scott Hansen and Pat McLean.
Well, good morning, gentlemen. Thank you very much.
We can barely hear you.
Oh, okay.
Are you on a speakerphone?
Oh, you've
or?
got your hand on the microphone on the
that
phone.
better, dude?
There we go.
Much better.
We hear you perfectly
How's
now.
that?
Perfect. What's up?
Okay. I'm approximately 2 years away from retirement, and I'm looking at moving out of the country and retiring in Southeast Asia.
Okay.
And
Which country?
I'm looking at Thailand. So, my question is, I have a 401k that has approximately $130,000 in it, and I'm thinking of using it to buy a condo over inland.
How old are you?
I am 64.
And where will your income come from once you retire?
I have basically I'm going to get Social Security, approximately $2,500, and I have an annuity with an income rider of $250,000.
What's the income rider?
It would bring me $1,000 a month.
And are you single?
I'm single.
How long ago did you purchase this annuity?
5 years ago.
So, and how much would the house cost you?
Approximately probably at the most $100,000 for a nice
And
one-bedroom condo over there.
And do you own a home here?
I own a condo in Sacramento, and it's paid clear.
And what would you do with that condo when you moved to Southeast Asia?
I'm thinking I would rent it out here so I can make a little income off of that.
And what's the value of the condo?
$160,000.
And how much income does it produce?
Nothing now. You're living in
If
it.
I was to rent it, I could probably rent it out now for about $1,400 a month.
What'd you pay for it?
I paid sickening $30,000 for it.
Oh, my. So
I got it at
let's talk
I
about
got
that.
it from a short sale.
Let's talk about that real quick. So if you sell, let's say it's 2 years from now, you're retired. If you sold that condo, all that capital gain that you just $130,000 of capital gain is forgiven because it's been your primary residence. If you convert that to an investment property and down the road you sell it, all that gain is going to be taxable to you.
Unless you own it till you die.
The challenge
Well,
with
that's
I like
the
where
goal.
you're going with this. The challenge with the 401k is it's although it says it's 130,000, it's not really 130,000.
Right.
Especially if you take it out all in 1 year.
You've got a silent partner. Right? Someone's got to pay for this COVID relief bills, right? So, but the challenge is that tax on that 130,000 might be anywhere from 12% to 30%, depending on how much you take in any 1 year.
And what other assets are there in the household?
That's about it. I have savings with 25K.
Okay. So
I wish all your savings wouldn't tie them to this annuity.
yeah, but Scott, that's
Right.
the first place I'd go because he bought it
How
5
old are
years
you?
ago.
I'm 64.
Yeah, he bought it 5 years ago. There's a surrender charge on it. It's probably 7 years. Right? So there's so many ways.
You got to look at that annuity.
There's so many
first.
ways you could. The first place I would go is the annuity. The second place I would go is if I couldn't.
100%.
The second place I would go if I couldn't do the annuity would be probably taking a new mortgage if you continue to decided to hold this condo, which may or may not be the right thing based on tax, and that you'd have to decide that you're probably going to own this until your dying day.
And I have no idea what foreign ownership of condos is in Thailand. The rules, the local rules are.
Understood, but the condo that he's got living in now, whether to convert it to a rental or not. But what would be wrong with actually either taking the money out of the annuity, which is, by the way, the first place I would look. First place, I wouldn't go further than that. Unless there were big penalties on this annuity, depending upon how bad the damage is, which is one of the reasons we don't like annuities, is because they're expensive many times, not always, but many times to get out of. The other technique you could do is you could take a new mortgage out on the existing condo while you live in it.
Yep.
Right? And then you could actually use the distributions from the IRA over periods of years in order to pay that mortgage down.
So have your 401k, let's say the mortgage payment's $600 a month, have the 401k, take the same $600 a month out of that 401k to make that mortgage payment.
And that way you're not driving yourself up into
like
a higher
that
marginal record. But
You got to look at the annuity.
But my guess is that it may be a combination of two of these. But the first place, if you were sitting in my office,
sometimes that annuity, the benefits might be significant enough that he's single and to actually keep it there.
I know, but he only bought it 5 years ago, and it's got a guaranteed minimum income benefit rider on it, which sounds. And he said it's $1,000 a month on a $250,000 annuity, which is 4%. So
you need to sit down with a financial advisor and dig through all this stuff.
Yeah. If you were sitting,
not someone who's going to sell you an annuity product.
Yeah. If you were sitting in my office, I know exactly the chain of questions I would go through. First would be the annuity. What's the cost to get out? What's the value of the GMIB, the guaranteed minimum income benefit? What is the cost of that? If it's not too expensive to get out of that, then we would just hit the annuity, pay cash for the house in Southeast Asia, Thailand, call it a day.
Right.
Then we discuss the tax implications of converting the condo into a rental property,
and the
ups and downs.
With the annuity, there could be the problem with these contracts. They're so complex, and everyone's different. But sometimes, if you take out more than say 10% of the contract, it collapses all the guarantees that you've got built in place. So you've got to. That's why they're really easy to get in.
They're hard to get out of.
So you got to be.
Okay.
So we're not big fans of those products because of some of these reasons.
But
now you own it. So now we got to figure out the best way to manage it.
But the question you called with is, can I use my 401k?
It'd be the last place I'd go.
It'd be the last place I went.
Okay.
The last place.
And odds are either one of two things, my opinion. If you're my brother, I'd say either sell that condo here and use those dollars, or get a mortgage on it probably now while rates are low. We know what they are.
Yep.
Right.
Then let's take a distribution once you retire from that 401k to cover that mortgage payment.
Yep. And or the annuity. Take a distribution from and or
one
the
of the
annuity.
reasons I was trying to keep the condo is because in Thailand, if things change or
When they
the
change.
world change in the future, I could always come back.
Okay, well then you answered the question
Yeah,
there.
then definitely
now
keep
we strike that one off the list of alternatives. So now we're down to, right? You're not going to sell the condo. Do you put collateral? Use the condo as collateral,
Or just take the
or take the money out of the
part
annuity?
of it, if your annuity has been aggressively invested, markets are high, good time to take some cash out. That's probably where you'll end up. But you got to look through all these things and really dig in to see if you take the money out of the annuity, what are the costs, not just costs and surrender costs, what are the costs as far as what's it going to do to the guaranteed income benefit that you've got built in there?
Which is,
Right.
but the answer to your question is no on the 401k.
Don't take a lump sum on that. You won't have enough money. The taxes will eat you alive on it. It'll be disastrous. So.
Alrighty.
You can't take it in 1 year. It just does not work well. So glad you called, Charles. Let's continue on here at Allworth's Money Matters. 833-99-WORTH is the number. We're talking with Michelle. Michelle, you're with Allworth's Money Matters.
Hi, how are you today?
We're wonderful.
Great. So we have just recently had a new grandchild.
Congratulations.
And
Is
one
it your
is-
first or
Thank you.
second or third, fourth? All
First.
right.
Our first.
Congrats.
Thank you. So I wanted to talk to you about the best way to invest money for the grandchild, not necessarily wanting to do one of those college plans in case, things change in the future on how those run. What if she doesn't want to go to college? What if she wants to travel abroad? But the best way to invest in for her.
How many kids do you have?
I have
first-
4 children.
Okay, 4 children. So you'll probably have more grandkids coming along, I guess.
Yes.
Right? Odds are, statistically speaking. Well, there's a couple different ways to look at it. One, you could use the 529 plan for this particular child. You always have a chance in the future to change beneficiaries. The things we like about it is the tax efficiency is phenomenal in the 529. If you don't want to do that, just say, I just want to have some money earmarked. Probably the cleanest way to do it is just to set up a separate account, keep it in your name. If it were me, I would probably just go out and buy the total stock market index, highly efficient as far as tax goes because it's mostly going to be capital appreciation, assuming it appreciates over the time. But she's newborn. You're not going to be spending the dollars until probably minimum age 16 if you wanted to help with a car, but probably college age or so. At that point, you could either sell the fund, you pay the tax on it, you can gift the fund, she pays the tax at her tax rate at that period of time. So it gives you that gives you full control. And
versus putting it in the child's name in terms of an UTMA or an UGMA.
Yeah, you can set up what's called the Uniform Transfer to Minors Act. It gives a little bit of tax benefits. The problem with that, it becomes the child when they reach age of maturity. Sometimes it can be pushed to age 24. But I have dealt with real life situations of clients with children with drug problems that they're hiding money that's legally theirs, right? Essentially.
So, Michelle, what's your overall family's net worth?
Well, if it's under 10 million, then
Well, it's probably under 10 million, but it's several million. I mean, we own 4 properties outright.
Okay.
We have good retirement.
Okay. So here's what, and you said no to the 529 plan.
I'd use the 529.
I'd use the 529
It comes
plan.
out of
And
your
let me-
estate.
And let me tell you why I would use the 529 plan. It comes out of your estate, number one. And we expect that the exemption for capital or for the estate tax exemption is going to fall from the current, 11.5 million. It's going to probably come down from there. The other is that you can change the beneficiary in the 529 plan anytime you want. So your granddaughter gets to be age 18 and says, I'm not going to college. I want to travel the world. You can just change the beneficiary to another grandchild and then give the child cash.
yes.
Right.
Or some appreciated
Okay.
security. Even better.
Even better. But the tax benefits,
are too good.
They're too good.
Particularly because it removes it from your estate. Right now, we have about $23 million for a couple. The vast majority of American families are under $23 million. But that's set to expire in a few years. It'll revert back to where it'll be about $11 million. And the Congress could, of course, change that in the future and say, no, we're going to reduce the state exemption even further.
The 529 has such great tax benefits, assuming that there's going to be multiple grandchildren in your life. You can just change the beneficiary and decide to give the money to the other kids. And that's why I asked the question about the overall net worth of the family, because there's going to be enough to put money in all the kids' names. So you want to use the most tax efficient vehicle possible.
So would you open up the 529 plan? How much can you put in a year?
Oh, you can
put about
in
$150,000.
Yeah, a lot.
Okay.
A lot.
Okay.
A lot.
And so
it still qualifies as an annual exclusion. You could use, how was it, 5 years? I've never had anyone who wanted to max them out. So
yeah, I don't remember. It's a lot of money. We've never even gotten to the limit.
No, me neither. No one ever wants to put that much in.
Get into it. She goes to college for 2 years. Can I then switch it to the next name?
Yep. And it stays out of their name. It stays out of your estate. It stays out of their name. So kid doesn't want to do anything, you don't have to give it to him. You just change the beneficiary at any point in time.
I had a client years ago was widowed, and in her husband's portion, he said he wanted to fund. I think it was education for kids from a previous marriage. There were 4 kids from a previous marriage, and there really wasn't quite enough dollars structured. It was going to be like each kid gets $10,000, whatever the number was, right? Certain amount of money per year for school. And so the way we had to satisfy this during that process is we actually took part of his IRA and earmarked it as a beneficiary IRA for the kids because there wasn't enough cash to fully fund the 529. And at the time, we were like, we don't know which of these 4 are going to be studious and are going to go to college and which ones aren't. But then as the kids got to that, they're all through that now. And client's been client for 20 plus years. We went through that entire process. Some kids went to college, some kids didn't. We just figured it out as we went. The most tax advantages possible. But the nice thing about that 529, you can change the beneficiaries, which is what we had to do in this situation.
And it actually, if the child is eligible for federal state aid, then it's not included in that because it's not in their name. And by the way, so I had this discussion with my wife 2 days ago about our nieces and nephews and 529 plans and whether they still make sense or not. This kind of tells you the dysfunction in my marriage that my wife and I were discussing this.
Why is it a dysfunction? It sounds like a normal marriage.
We'd have better things to talk about than how 529s will be treated in the future based on whether education is free in the future. So her question was, what happens if all education becomes free?
Or why not take as many loans as possible and then just have the government forgive those loans?
Well, I am along those lines, but keeping the money in your name in the 529, there will be changes in how all of these things are structured. But even the tax efficiency of the 529, don't even consider anything else. If you live in what state?
Okay. California.
Oh, just go to scholarshare.com. You need the child's birth date, social security number. Once you have that, you can go online, get the age-weighted aggressive growth fund.
Something along those lines. Yeah. You want to be, because you want to be as aggressive as possible. You've got so much time. You've got time to go through multiple market cycles.
Age-based aggressive growth. All righty?
Okay. So you did mention, though, take out as many student loans as you can in case.
Well, who knows? I mean, she's like.
No, not her, but like, let's say you had a child in college now.
I do.
We have kids in college. Would we take out student loans?
Well,
even
you
though
might
we
not
are
qualify. Depending on your income, you might not qualify for that.
If the child is on their own and qualifies, then it may make sense for them to take out. But you're not going to co-sign on anything. It's just the child. You may not, if the child is a dependent of yours, you may not qualify for that.
Yeah, we won't. Okay.
Yeah.
All right.
I mean, that's.
Well, thanks.
All right. Appreciate the call.
It's
Appreciate you guys. Take care. Have
thanks,
a great
Michelle.
day.
It is kind of crazy, isn't it?
Yeah. Yeah. I took student loans out in college.
I remember in college, I went to apply for a student. I worked, had a little tree trimming business. I worked out of my bedroom, essentially, while I went to junior college and sold it, made enough money to basically kind of fund my last couple years of university. And I went to apply for a student loan, and they wouldn't give me one because I made more than it was only like 10 grand.
You made too much money because you worked.
Yes, and I had friends that were had summer jobs that would quit their summer jobs before the summers opened because they would keep an eye on that limit, because if they made over that limit, they wouldn't qualify for the student loan.
It is unintended consequences. I got them because I worked as a waiter, and back then it wasn't. Quite frankly, I'm going to tell the truth. I may not have declared 100% of my income because it wasn't required.
Oh, back in the day, it wasn't.
It wasn't there, and so I would take these student loans, and I had a brokerage account at Dean Witter. Dean Witter was my brokerage account. So
you took student loans and invested in risky securities.
I did when I was in college. I don't know if I'd give that advice to myself today, but that's what I did.
It's probably. If it didn't work out, you would have
been fine.
You would have learned. It wasn't very much money. I mean, I love watching young people do stupid things with their dollars because they're small amounts.
Yes,
and it's small fixes.
Yes.
What I don't like seeing is someone who's 55 or 60 make poor choices with their dollars. They take a lump sum from their retirement and have had very little experience investing that size of dollars and go out and make those decisions. That's where you see people they make these decisions with their finances that are essentially irrevocable.
Yes.
And when the markets do what they do, oftentimes they're in a situation where it'll change their life, not always for the best, right?
Yeah. Landing the plane is the most dangerous part of the flight, by the way. Landing your retirement is the most dangerous part of your retirement savings.
Which is why it's, particularly as you are nearing retirement, it is really important that you've got the right kind of plan in place. And if you don't have one now, there's great financial advisors around the country. There's a lot of bad ones as well. Obviously, we're part of Allworth Financial. We think we've got great advisors. Meet with people every day, helping them plan their financial futures.
And to that point, this week we have a workshop on Social Security. If you go to our website, allworthfinancial.com, you could sign up for our virtual Social Security workshop so that you can better understand how Social Security plays a role in your retirement
And
planning.
if you want to think about how do I have a consultation with an Allworth advisor, you can figure that out as well, allworth.com. We're out of time. It's been great being with you. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.